All right, thanks, Jared, and thanks everybody for tuning in. It's been interesting as this accounting standards update has evolved, as you can see from the number of it, 2014-9. This standard was actually finalized in 2014, but that was the culmination of an ongoing conversation that began in 2010, if not sooner. And so this is a standard that's been lumbering along with an extended implementation time frame. And our feeling is that it's been difficult for people to really understand that now is the time to be focusing on this standard. It is going to be effective a year from now, and we'll talk through all of that. So hopefully what this CPE and this webinar will do is provide you with an overview of the standard. Bear in mind that this standard is 600 plus pages long, so it's impossible to get into comprehensive, detailed analysis of the entire standard. What we hope that we do today is give you some food for thought so that you can start to recognize issues, understand where there may be some challenges with implementation, and begin the conversation both internally and with your accountants as the implementation date approaches. So we'll begin with an overview talking about what the Financial Accounting Standards Board was trying to achieve with this standard. We'll give an overview of the basic principle of the standard, the effective dates, how will implementation work, and which industries will be impacted. And we'll spend the bulk of our time walking through the 5-step model that all companies will adopt as they implement this model. So what the FASB was trying to do is converge U.S. GAAP with international financial reporting standards. In an increasingly interconnected world, it was problematic to have one of the most fundamental aspects of financial reporting, being revenue recognition, differ from country to country. So the FASB was working with the International Financial Reporting to try to converge a single model that would be applied globally. And beyond globally, even within GAAP, for U.S. companies, revenue recognition principles differed by industry. So if you were a software company, you tended to follow software guidance. Contractors followed contractor guidance, service companies, their own guidance. And that's problematic. What this standard does is create a single framework that no matter what industry you're in, it will apply to you, and you will apply this model. And there will be some enhanced disclosures that are intended to both simplify and provide more useful information to users of the financial statements about revenue recognition, which of course is one of the most fundamentally important elements of financial statement analysis for users of your statements. So when are you going to have to implement this standard? For public companies, it's for periods beginning after December 15th, 2017, which is fiscal 2018. So for periods that are beginning just a couple weeks from now. And as you'll see in a moment, some of that may apply to actual fiscal year 2017 or 16. Non-public companies get another year. So non-public companies will adopt for years beginning after December 15th, 2018. So that's calendar year 2019. Although, again, the application may involve restating some 2018 activity. There will be two basic methods of transitioning to the new revenue recognition guidance. Option one is a full retrospective restatement. So you would go back to the beginning of the earliest period presented. So if you are a non-public company adopting in 2019, you would go back and restate 2018 as well to apply the principles of the new statement with a cumulative effective accounting principle applied at the beginning of 2018. Option two is a bit different. You would not restate 2018 for 2019 adoption. You would have a cumulative effect at the beginning of 2019 for certain contracts that were in process. I think that we're expecting that option two is going to be the adoption that most of our clients and privately held companies utilize when adopting this new standard. So who's going to be impacted by this standard? Again, really just about everybody. This is intended to be universal. Rather than focusing on what industry you're in, I think what you want to be considering is what are the indicators that the implementation is going to be more or less complex. And some of the indicators, regardless of industry, of complexity are multiple promises. Do you have contracts that have multiple deliverables to your clients? Are services delivered over a long period of time or a short period of time? Do your standard pricing terms include variable pricing, rebates, discounts, and that sort of thing? And are there any inherent uncertainties that you need to be thinking about as you estimate the amount of revenue that you're ultimately going to recognize? All of those factors can indicate that this may be a more complex process, and to the extent that you think they exist within your organization, you want to be as proactive as possible in thinking those through, because it may take more time to implement this new standard. Another item that I'll mention is that this standard does absolutely apply to nonprofit organizations, and there are some ongoing discussions amongst the standard setters with respect to application to nonprofit entities. Specifically, contributions are exempt from this standard, so that's good news, but there's the questions remain as to what constitutes a contribution when you're receiving grants from foundations or the federal government. And if you're a nonprofit receiving grant revenue, you'll want to monitor those discussions. The trend is that a lot of grants that may have historically been accounted for as exchange transactions and therefore revenue may be considered as contributions going forward and would be exempt from this standard. But there will be more to come as those issues progress. They're still in the discussion phase. So we mentioned the 5-step model. The step 1 being identify the contract with the customer. The second being identify the performance obligations or the promises within the contract. The third step is to determine the transaction price, then allocate that transaction price to the various performance obligations in the contract and recognize that revenue as you satisfy each performance obligation. So the principle, those 5 steps, are putting you in a position to recognize the revenue that depicts the transfer of promised goods or services to customers in an amount that reflects the consideration that you're expected to be entitled in exchange for those services. It sounds fairly straightforward. It sounds logical. What we'll talk about as we go through this presentation are that there are complexities and challenges at every step along the way, and those include the items listed here, and we're going to get into those in more detail as we walk through each of the 5 steps of the process. So the first step is identifying the contract with the customer, and you need to be thinking about issues including collectability. If you've got separate contracts, when is it appropriate to combine them and really consider them as a single contract? And what do you do after you've established a contract if you modify it partway through the delivery? So you've got a contract when it's been approved. That can be in writing, it can be oral, or it can also be based on customary business practices. And the question becomes, when are the rights of each party identifiable? When are the payment terms identifiable? When has commercial substance been established? And when is it probable that you're going to collect the consideration that's identified in the contract? If you don't meet those criteria, you don't have a contract. And that means you wouldn't recognize any revenue, even if you received cash and it's non-refundable, until there are no remaining performance obligations. It's non-refundable, and the contract has either been terminated or consideration is non-refundable. That may be a change in current practice for some. If collection is deemed doubtful, but you've received revenue that's non-refundable along the way, there is diversity in practice currently, and some would recognize revenue on a pay-as-you-go basis in some of those situations, but that may not be appropriate under the new standard. So let's take a look at an example. So in example 1, an entity is a real estate developer, and they enter into a contract for $1 million building. The customer is going to open a restaurant. There's a lot of competition in this area where the restaurant is. The customer isn't particularly experienced in the industry. They've paid us a non-refundable deposit of $50,000 at the inception of the contract, and we've got a long-term financing agreement for the remaining 95%. And the question is really, do we have a contract? If so, how much? And what is the revenue that we would recognize? the key here is that collection isn't probable. There's too much doubt about whether the customer is going to be successful and be in a position to pay back the financing, which is the bulk of the consideration that's going to be received here. So we would determine that we don't have a contract, and we wouldn't even record the $50,000 of revenue at the inception of the contract in this instance. An area where there can be considerable complexity and where you'll want to spend some time thinking about your normal business practices and the implications in this new revenue recognition model, if they exist, is when it comes to contract modification. And the key issues with a contract modification are, is it in fact a modification of existing promises that are embedded in the existing contract? Are they in effect adding on new standalone performance obligations, in which case it may just be accounted for as a new contract? In instances where you're modifying terms of existing performance obligation, the analysis gets a bit complicated because you've got to consider how the modification impacts different performance obligations within the contract. Does it change performance obligations that you have completed already or are in process of completing or haven't yet begun? And depending on the answer to those questions, you may recognize those modifications prospectively, or you may have a cumulative catch-up to adjust revenue that you had recognized in previous periods to the extent that the modification impacts performance obligations that were in process. And that can be a fairly complicated analysis, so just try to provide you a little bit of a heads up there. And now I'm going to pass it over to Chuck, who's going to start talking about step 2 in the model.
So step 2 is identify the performance obligations in the contract. So at contract inception, the entity needs to identify each promise to either transfer a good or service that is distinct or a series of goods or services. So a good or service is distinct if the customer can benefit from the good or service on its own, and the good or service is separately identifiable from the other promises in the contract. So I want to use a basic example here. Assume a manufacturing entity that makes machines. If you entered into a contract to build a machine for a customer, and the only obligation was to build a machine, the assumption would be that the customer's employees can install the machine on their own. That would just be one performance obligation. Now, to take that a step further, if the contract was to build a machine and install it, maybe the customer's employees can't install it because it needs to be calibrated or something like that. That would also just be one performance obligation, because the customer wouldn't be able to use the machine or benefit from the machine if it wasn't installed. To take that a step further, if the contract was to build a machine, install the machine, and there was a service contract component, then the service contract would be a separate performance obligation. And in that case, you'd have two performance obligations, one being the machine and installing it, and the second being the service contract. Another example that I'd like to touch on is warranties. Generally, there's two main types of warranties. There's the standard assurance warranty, which just provides protection to the consumer that the product will work as intended for a fixed period of time. And then there's an extended warranty, which typically covers defects that arise after the initial warranty period. So extended warranties are typically separate performance obligations. The new standard requires the entity to distinguish between the two different types of warranties and allocate the transaction price to the two different performance obligations based on a standalone selling value. If there's no separate purchase option, then the entity would apply just the cost accrual guidance in ASC 460 guarantees, unless the warranty provide an additional service to the customer in addition to the assurance that the product would comply with agreed upon specifications. So if the entity promises both assurance and service type warranties, but it can't reasonably account for them separately, then it would just account for them both together as a single performance obligation.
So I think that this is one of the most important steps, and although it may sound straightforward, you start to get the idea here that the complexities associated with implementing this standard include that the accounting answers may be different from what appears to be the answer based on the words that are written in the contract. You really need to look through to the commercial substance and understand which performance obligations deliver standalone value to the customer. And one more example before we move on. Suppose you had a software product that you installed or that you sold, and it included a license to use the software as well as a non-refundable upfront installation fee that was due upon installation. Is the installation fee a separate performance obligation? The answer is it depends. It depends on whether there's a specialization involved such that your team is required to do that installation, and the client, the customer, is not able to go and buy. If they were just to buy the license rights, could they go elsewhere and have somebody else come in and implement the software? The issue is that the installation is no good in and of itself, and the software license, you're not able to use it without the installation. They're so interrelated that would be considered a single performance obligation, and the implication of that is that all of the revenue would be recognized over the license period, even though that upfront fee may be non-refundable and due at inception of the contract or near inception. Whereas if you're taking some off-the-shelf software that may be acquired separately from other installation services, and the customer has a choice of either contracting with you to do the installation or contracting with another vendor to do the installation, in that case it's very similar, but you would conclude likely that in the second situation, each of those performance obligations has standalone value to the customer, and you would recognize the revenue as two separate performance obligations with the installation revenue up front. So it gets complex, and if you miss the identification of the separate performance obligations, it's going to be very difficult to navigate the following steps of the implementation. So moving on to step 3, the third step in the analysis is determining the transaction price. And in the transaction price, it's fairly straightforward. It's the amount of consideration to which the entity expects to be entitled in exchange for the promised goods or services in the contract. Sometimes that may be fixed, sometimes it may vary. If you're in the practice of offering discounts, rebates, refunds, credits, price concessions, incentives, if there are performance bonuses incorporated into contract pricing, penalties, or other similar items, all of those variables are going to require you to make estimates regarding the total amount of consideration. And so again, at the bottom of this slide, what you can see is some of the complicating factors in step 3 of the analysis would include variable consideration, constraining estimates of variable consideration. What that means is you can't recognize revenue that you've estimated if it's possible or probable that there may be a future reversal of that revenue. So you may determine, and we'll look at some examples, that perhaps you're going to earn a performance bonus, for example, but you're not able to conclude that a reversal of that revenue because you're going to miss the target isn't probable. So you may have to delay recognition of certain elements of revenue because of the probability of future reversal, and those are called constraining estimates of variable consideration. Other elements to consider are significant financing components. If you have extended repayment terms, you may have an element of the total consideration that relates to the delivery of the goods. Suppose you're delivering a specialized piece of equipment, for example, and you've delivered it, you're done upon delivery of the product, and maybe it's a $500,000 piece of equipment, but you've accepted extended repayment terms, and maybe the principal isn't going to be paid off until 5 years from the date of delivery. In that case, the equipment really isn't $500,000 because part of the value of that total consideration is allocated to the fact that we've provided financing and we're earning some interest on that financing. So that's where financing components can enter in. Non-cash consideration would have to be valued and thought about in determining the total transaction price as well, and also consideration payable to a customer. And in certain contracts, you've got to pay a customer cash, and what you've got to do in those situations is you've got to analyze, are you receiving a distinct good or service in return for the cash that you're paid, in which case you're just buying something and you would account for that as if you had purchased that good or service. In other cases, you may not be receiving a distinct benefit, and that can happen in retail in certain shelving types of situations. You may have fees that you've got to pay to the retail organizations to configure their shelves to sell your product. And if you're not controlling the shelves and receiving a distinct benefit, that consideration payable isn't the acquisition of a good or service, and it would be a reduction of the total consideration. So those are a few of the things that you'll need to be thinking about as you work through step 3 of the model. So you've got to consider, as I mentioned earlier, how likely is it that there may be a future reversal of revenue? And the more likely it is, that's a variable constraint, and it would preclude you from recognizing revenue in advance of those issues being addressed and the likelihood of the reversal becoming remote. So some of the indicators that you need to think about and analyze here is that the amount of consideration is highly susceptible to factors outside the influence of the entity. And we'll look at an example of that in a moment. If resolution of uncertainty about the amount of consideration isn't expected for a long period of time, it's going to be a while before we know whether we're going to be entitled to all of that revenue, then that's an indication that a reversal may be likely. If we've got limited experience, we're just not able to estimate the likelihood of achieving a performance target or estimating the volume of ultimate sales that impacts variable pricing, for example. If we just don't have a track record, we're more likely to find ourselves in a position where we've got to delay revenue recognition because of the inherent uncertainties. And if we have a broad practice of offering price concessions, making changes on the fly, that sort of thing, if the less set in stone and predictable the revenue stream is, the more likely it is that we're going to have to delay recognition. And if there's a broad range of possible consideration amounts, again, that inherent uncertainty is something that's going to be problematic in terms of recognizing revenue early in the contract period. So when it comes to variable consideration, there's really 2 approaches that you may choose to adopt. You've got to do one or the other, and once you've decided which one to use, you've got to stick with it throughout the term of the contract. The first is expected value, and the second is the most likely amount. And so the expected value is when you've got a range of potential outcomes, what you would do is you would calculate essentially a probability weighted value based on those potential outcomes. So an example of where that might be appropriate would be, suppose there is some incentive built into the pricing, and if you're able to complete a building, for example, prior to a targeted date, and maybe every week prior to the date, you get a $5,000 incentive bonus. And maybe if you take the example further, and if it's the completion is delayed, then every week after that target date, maybe there's a penalty that's incurred. Well, the variable consideration is based on the timing of completion, and there's a range of potential outcomes. And you think about, based on your history of similar projects, what's the probability of earning a significant bonus coming in right on the target date or incurring a penalty? And the probability weighted calculation would be the expected value. And at the contract outset, that's the amount that would be the basis of your revenue recognition. Contrast that with the most likely amount. That's sort of a yes or no type of an answer. It's the single most likely amount, and if you're in we're going to earn the bonus or we're not going to earn the bonus, rather than a range of potential outcomes, that's sort of a yes or no question, and the most likely amount would be based on the point estimate, the answer to the yes or no question. So let's take an example. The entity is a construction company. We enter into a contract to build a commercial building for a customer on customer-owned land for a promised consideration of $1 million and a bonus of $200,000 if the building is completed within 24 months. The entity accounts for the promised bundle of goods and services as a single performance obligation satisfied over time because the customer controls the building. And these are some concepts that we'll be looking at a little bit later. At the inception of the contract, what do we expect? The $1 million is the total consideration. Our costs are going to be $700,000, and our profit margin is 30%. So the issue is that we're excluding the $200,000 bonus from the transaction price. We just don't know if it's probable that if we recognize that, if we assume we're going to earn that, and we start recognizing that revenue up front, there's too much that's beyond our control in this case to include that $200,000 bonus. And so we're going to defer that revenue until we get to the point where we think a future reversal of that $200,000 is remote.
Okay, step 4. I think it's important to note that if in step 2 you identify only one performance obligation, then step 4 isn't needed. It's only needed when there are multiple performance obligations identified in the contract. Generally, you'd allocate the transaction price to each performance obligation on a relative standalone selling price basis. The best evidence of a standalone selling price is the observable price of the good or service when the entity sells that good or service separately in similar circumstances to similar customers. If the good or service isn't sold separately, then the entity must estimate the standalone selling price, and there's a few different methods that you can use for that estimate. The first is the adjusted market assessment. The second is an expected cost plus a margin. And the third is a residual approach. With the adjusted market assessment approach, the entity could evaluate the market in which it sells the goods or services and come up with an estimate price that they expect the customer would be willing to pay for that good or service. So with this approach, the entity may look at competitors and what competitors charge for similar goods or services, and then adjust those prices as necessary to reflect the entity's costs and margins. The expected cost plus margin approach, the entity would forecast its expected costs of satisfying the performance obligation, and then it would just add an appropriate margin for that good or service. With the residual approach, the entity would start with the total transaction price and then back out the standalone selling prices of other goods and services in the contract. I think it's important to note that you really can only use the residual approach if the entity has not yet established a selling price for the good or service, and the good or service has not previously been sold on a standalone basis. Or if the entity sells the good or service to different customers for a broad range of amounts. In that case, the selling price is highly variable, so a standalone selling price is not evident from the past transactions. So no matter what approach you use, the key is that the entity is maximizing the use of observable inputs. So for example 4, an entity enters into a contract with a customer to sell products A, B, and C in exchange for $100. The entity regularly sells product A separately, and therefore the standalone selling price is directly observable. The standalone selling prices of product B and C are not directly observable. So because the standalone selling prices for products B and C are not directly observable, the entity has to estimate them. To estimate the standalone selling prices, the entity is going to use the adjusted market assessment approach for product B and an expected cost plus margin approach for product C. So the entity estimates the standalone selling prices as follows. For product A, it's $50. They use the directly observable method because that's what they typically sell the product for on a standalone basis. With products B and C, as I mentioned before, they don't typically sell those products on a standalone basis. So for product B, they use the adjusted market assessment approach and estimated selling price of $25. For product C, they use the expected cost plus a margin approach and estimated a selling price of $75. So the total is $150. So essentially, the customer is receiving a discount for purchasing the bundle of goods because the sum of the standalone selling prices, $150, exceeds the contract price of $100. So essentially, this is a volume discount. And with volume discounts, the discount is typically allocated proportionally across all products. There are circumstances in which the discount could be allocated to one, but not all of the products in the bundle. I'm going to refer you guys to the ASC 606-1032-37 for examples of situations where that would be appropriate to allocate the discount to only one of the products in the bundle. It's somewhat complex, and just in the interest of time with this webinar, I don't want to get into too many specific examples of allocating the discount to one specific product.
So moving on to step 5, and I guess before we do that, I would just say I think Chuck's right that he's referring to an element of the analysis that can be fairly complex. The basic principle with respect to allocating some of those variables to a single performance obligation include that it really does reflect the commercial substance and the standalone selling price that would be associated with that specific performance obligation, but there's a lot to that analysis. So step 5 is the home stretch, and at this stage in the game, we've got a contract. We identified that up front, and within the contract, we've identified each specific performance obligation, determined the transaction price, which may include some estimates that we've got to develop along the way. We've allocated it to each of the performance obligations, and now the last step is as we deliver on each of those performance obligations, what's the pattern that we use to actually recognize that revenue? And it can either be, and we're going to recognize the revenue as we satisfy the obligation, as the goods and services are transferred to the customer, and as the customer really benefits from or obtains control of the good or service. And that may happen over time or at a point in time. So we'll recognize our revenue over time during the contract period if any of these following criteria met. It doesn't have to be all of them. Any one of these would allow us to recognize revenue over time. And those include that the customer receives and consumes the benefits as we perform. So that would be a cleaning service, for example. The customer controls the asset as it is created or enhanced by the entity's performance. This may be tangible or intangible goods. The customer controls the asset, and they're benefiting from this as we go, so we would recognize over time. Or the third possibility is the entity's performance does not create an asset with an alternative use to the entity. And the customer, although they don't have control, they do have an enforceable right to payment for performance completed to date, and we expect to fulfill the contract as promised. So when we're thinking about alternative uses, this may come into play if you're developing very complex or specific machinery that's built to order. If you're developing a product that is built to spec, and it really, because of the degree of specialization, really doesn't have an alternative use. If something falls apart with the relationship with this customer, you can't just go and sell it to another customer. Then you may determine that good does not have an alternative use. Whereas if it's a more uniform product and everything else is similar with the time it takes you to construct the product and the price and everything else, but look, if the relationship with this customer falls apart, you could just go find somebody else and sell it to them. You may determine that it does have an alternative use, and that's going to have a direct impact on whether you're recognizing revenue over time as you construct the asset, or you have to wait until it's delivered at a point in time. So if we don't meet those three criteria, and in which case we'd be recognizing the revenue over time, it's going to be a point in time. So the question is, when have we satisfied the performance obligation? What's the appropriate point in time to recognize that revenue? And that can require some judgment. And these are indicators that you'd be thinking about as you perform that analysis. When do you have a right to payment? When has legal title transferred to the customer? Has the customer taken physical possession of the item? Have the risks and rewards of ownership transferred to the customer? And have they accepted the asset? Those are all indicators that control has passed to the customer, and it's not until that point in time that you would recognize the revenue, and it would all be done in one lump sum. And you need to be aware of different clauses that may allow the customer to return. If there's different customer acceptance provisions or that sort of thing, you really haven't, the risks and rewards haven't transferred until the customer's accepted the asset, and until that time period has lapsed or the customer has formally accepted, you're not in a position to recognize any of the revenue. So let's look at an example. So a customer, an entity, is developing a multi-unit residential complex. The customer enters into a binding sales contract with the entity for a specified unit that's under construction. Each unit has a similar floor plan and is of a similar size, but other attributes of the units are different. For example, the location of the unit within the complex. So we're building an apartment or a condo, and somebody's contracted with us. They are paying us a deposit upon entering into the contract. It's refundable only if we fail to complete the construction in accordance with the contract. The remainder of the contract price is payable upon completion of the contract when the customer obtains physical possession of the unit. If the customer defaults on the contract before the completion of the unit, the entity only has the right to retain the deposit. So this gets into a question of, so what do we do with our revenue here? Do we recognize it over time, which is often the case for contractors who are going to use a percent complete methodology to measure their progress towards completion of a project, and they'll recognize revenue over time based on the level of effort that they've put in compared to their estimate of the total? Or would you have to recognize revenue at a point in time, which is going to be at the end? And in this case, the entity is going to determine that it's only got an enforceable right to, that it does not have an enforceable right to payment for performance completed to date, because we only have a right to the deposit paid by the customer. So because we don't have a right to be compensated for the work that we've completed, say, at any point midway through the contract, it's not something that we've satisfied over time. We wouldn't be able to apply a percent complete methodology, and we would have to defer revenue recognition even for the upfront payment until the end.
So there's some other items that are addressed in the new standard. So these are some things that you should look out for. If any of these items apply to your business, then you'll want to analyze the potential impact of the new standard on these items. I'm not going to get into detail on these now. If time permits at the end and anyone has questions, we can ask and we'll do our best to answer those. So generally speaking, the prior disclosures used boilerplate language that really made it hard for users of financial statements to understand revenues and judgments related to revenue and how revenue is related to the entity's overall financial position. So not only does this standard address how revenue is recognized, it's also addressing the disclosures as well. And non-public entities, at a minimum, they're going to have to disclose revenue disaggregated according to the timing of the transfer of goods or services, and qualitative information about how economic factors affect the nature, amount, timing, and uncertainty of the revenue and the cash flows. There's going to be required disclosures for opening and closing balances of receivables and contract assets and contract liabilities if they're not otherwise already separately presented. And then there's going to be new disclosures related to performance obligations. So, when the entity typically satisfies performance obligations, whether it's upon shipment or delivery or as the services are rendered. Satisfaction of the payment terms. So when payment is typically due, whether it's variable, whether there are any financing components. You'll also have to disclose the nature of the goods or services the entity has promised to transfer, obligations for refunds, returns, or warranties and other related obligations. So the next slide here is just an example of some of the disclosure, breaking it out between geographical markets and then major goods or service lines. And then also on the bottom there, you can see that the timing of the revenue recognition, whether the goods transferred at a point in time or the services transferred over time. This is just a small example of the new disclosures. There's going to be a lot there, so it's going to be important for you to not only look at the revenue recognition piece, but also the disclosure piece, because there may be processes or procedures that you're going to have to put in place to capture the information that you're going to need for the disclosures, and that'd be information that you typically didn't track.
And I think that's a good point, and it's something that you really want to spend a little bit of time thinking about, and think about when this might impact you and whether your systems are able to support some of the enhanced disclosures. So I would say we often will see in financial statements fairly generic discussions of revenue recognition, where there's a couple of sentences that basically say that the company recognizes revenue as the goods, the services are performed. That sort of generic discussion isn't going to be good enough. You'll have to really relate that to, based on the nature of the services that you're providing or the goods that you're producing, how do the elements of this 5-step process dictate the revenue recognition patterns? And some more in-depth conversation is going to be included in the footnotes going forward if you're not doing it already. And the other thing is to think about the systems. This disaggregate. Some people may do this analysis or be thinking about this analysis and saying, well, sounds very similar to what I'm already doing. I don't anticipate that there's going to be some significant changes to the timing of when I recognize revenue, so I'm not going to be too concerned about this. That may be the correct answer, but you also just want to be careful of understanding the disaggregation of revenue by different service types and revenue streams. If that's not disclosure that you're accustomed to providing, and if your systems make it difficult to quantify and disaggregate that total revenue, there may be some challenges in implementing the disclosures that aren't really related to the overall, it may not be because there's changes in timing and it's going to significantly impact your P&L, for example, but there may still be some complexities in your ability to comply with the enhanced disclosure requirements. So I do want to go back, I think, and take a look at a couple of these other items and give you a bit of a flavor of what some of the issues may be here. Contract costs. In accordance with the revenue recognition standard, your direct incremental costs to obtain contracts will be capitalizable. And if you're delivering those services over a period that's greater than 1 year, you would amortize that over the contract term. So depending on how material your contract costs may be, you'll want to be aware of that up front and maybe spend some time thinking about how you'll quantify those costs. And just like most other elements of this standard, there definitely are some complexities involved with contract costs, for example, suppose you send a team of salespeople across the country to prepare a bid and propose on a project, and they win the contract, and you pay some salespeople a commission. In those cases, you've incurred a number of different costs, including the travel costs, the cost to develop the proposal, and the commissions to the salespeople. You would say that they're all direct costs associated with winning the project. However, the travel costs and the cost to prepare the proposal, you would have incurred those costs whether or not you actually won the bid, whereas the commission would only have been paid because you won the bid. And so even though they're all direct costs, in my example there, only the commission costs would be capitalizable. Other items would be bill and hold, and that's not at all uncommon. There's definitely criteria that need to be established and met in order to recognize revenue up front in a bill and hold type of a situation. You need to make sure that that good really has been delivered in the sense that it's segregated, it's distinct. You can't take that item and satisfy an obligation to another customer for it. And you also need to consider the fact that you haven't only sold an item, you're also providing a custodial service and holding on to that asset for some period of time. And that custodial function likely also has some value associated with it, probably would need to be considered as its own performance obligation, and you may have to have some of the total consideration applied to it based on the value of those services. When it comes to consignment sales, I think you'd need to be very careful with those. You may have something that looks like a sale up front, but you're holding that item on consignment. In most of those cases, in a lot of those cases at least, you would say that the risks and rewards of ownership haven't transferred to the customer. You would not be able to recognize revenue up front in most consignment sales. Most of these other items on the list really get at understanding what material rights may be included within the contract, and to the extent that there are ancillary rights that are conveyed to the customer, points, loyalty programs, gift cards, all of those types of things, to the extent that they represent standalone value to a customer, they would meet the definition of a performance obligation under the new standard, and you would have therefore allocate a portion of the total consideration to those performance obligations and defer recognition until you've satisfied those performance obligations.
So how will the new standard change U.S. GAAP? So today, as Marcus said in the beginning, there's numerous revenue recognition guidance that, depending on industry, really, a lot of it's industry specific. Now there'll be this one consistent principle to recognize revenue regardless of the industry. And before, like I had mentioned with the disclosures, there was just really a lot of boilerplate language that was, real general and didn't provide the user of the financial statements with a lot of useful information. So the new standard is going to have a lot of new disclosure requirements that will provide users with more useful information about the organization, the organization's contracts, and the customers. So there's many goods or services performed in a contract with a customer are deemed to not be distinct under today's standards. With the new guidance, you're really going to have to look into performance obligations and breaking those out and allocating the transaction price among the various performance obligations. And the Marcus had touched on too the variable consideration. Currently, it's accounted for differently across various industries, but with the new guidance, there's really going to be like a single model for this, and rebates, discounts, bonuses, all that kind of stuff will all be treated in a similar way.
Yeah. So where does that leave you if you haven't really begun an analysis of implementation of the new standard? what you really probably want to be considering is developing a project plan that takes into account some of the factors that we said at the outset of the training. And now that we've talked about some of the examples, you can see how the number of different performance obligations within a contract, the amount of variability and uncertainty in pricing, and the length of time over which performance obligations are satisfied are all indicators of complexity and an increased level of effort in adopting the new standard. So what do you do? What we would recommend is that really now you convene a team internally and think about who within your organization is responsible for implementation of the new RevRec standard. Do those individuals have access to the resources that they need in order to be successful and document your compliance with the new standard and develop and implement a plan? And then have those folks begin a preliminary analysis where you can document in accordance with the new standard, how is it going to impact your revenue recognition? Share your preliminary conclusions with your auditors, with your accounting firm. Make sure that you're thinking about some of these areas consistently with how they are. It's important that companies and financial statement preparers take the lead in the analysis. Auditors can provide some degree of coaching and some input and can help, but it's got to be the primary initiative has to reside with the preparers themselves. So once you've developed your preliminary conclusions, do a check-in with your auditor. Make sure that you're in agreement with the basic methodology. If there's any tweaks required to that program or your plan, you'll know it up front, and then you'll be prepared for actual implementation, which, again, that for private companies is calendar year 2019, but based on the implementation that you elect, some of that could impact activity that's happening during 2018 if you actually went back and did a full retrospective implementation. So the 600-page standard is full of examples. It's full of nuances. In the hour that we've had, we hope that this has provided you with at least a broad overview of how the five-step process works and some of the basic concepts. But to the extent that you think some of these issues may represent some complexities that you're going to need to be dealing with, there's an awful lot to it, and you want to begin those conversations internally and with your accounting firm sooner rather than later. So thanks for joining us. Hopefully it's been useful. The presentation's been recorded, and we look forward to hearing from you if you've got any questions as you think through how to implement this and where there may be challenges for you. We're happy to provide some input and guidance as you tackle this. Thank you.